Welcome back to BullionIQ, the channel where we cut through the noise and focus on what really matters in crypto, finance, and the global economy. If you are holding XRP, Bitcoin, or any digital asset and you care about what comes next, you are in the right place. Time is short, the markets are tense, and today is one of those days where a single decision can shift everything. So let's get straight into it, because what happens now could shape the direction of crypto for weeks, even months ahead. Right now, XRP is trading around $2.10, slightly down on the day. That may not seem dramatic on the surface, but when price moves start to align with political, legal, and economic events, that is when things become serious. We are not just looking at charts today. We are watching the intersection of government decisions, market psychology, and global risk. This is where real opportunities and real dangers are created. Today is important for two major reasons. First, the United States is releasing new unemployment data. These numbers often influence what the Federal Reserve does next. If employment weakens, the Fed may be pressured to slow down tightening or consider easing. If the numbers are strong, the Fed may stay aggressive. Either outcome affects liquidity, risk appetite, and investor behavior. And when traditional markets react, crypto almost always follows. But the bigger story today is political and legal. All eyes are on whether the Supreme Court will rule on President Trump's tariff policies. This decision has the potential to shake financial markets across the board. Tariffs impact inflation, trade flows, business confidence, and ultimately economic growth. When markets do not know which direction policy is going, investors tend to reduce risk. That uncertainty is one of the reasons we have seen crypto selling pressure over the past few days. This is also why so many traders are cautious right now. Even on a day that is already known for volatility, what some call a Freaky Friday, the added risk of a Supreme Court decision creates a situation where price can move fast in either direction. If the ruling supports tariffs, markets may fear higher costs and slower growth. If the ruling limits them, markets may see that as relief. Either way, crypto is not isolated from this environment. It reacts to fear, optimism, and shifts in global capital just like any other asset class. At the same time, we are watching the long-term regulatory picture, especially in the United States. One of the most important developments is the progress of the Clarity Act. According to political analyst Eleanor, this bill is expected to move through the Senate Banking Committee, then merge with the Agriculture Committee's portion, and eventually head to a full Senate vote. After that, it would return to the House, and if approved, go to President Trump's desk. In the best-case scenario, this could happen as early as March. More realistically, it could stretch into the summer if changes are made along the way. The key point is this: regulation is coming. The crypto market is no longer operating in a legal gray zone forever. Investors, institutions, and governments are preparing for a framework that defines what is allowed, what is protected, and how digital assets fit into the financial system. For XRP holders especially, this matters deeply. XRP has spent years in legal uncertainty. Clear rules could unlock institutional adoption, banking partnerships, and real-world use at scale. The market is not just waiting for price action, it is waiting for clarity. What makes this even more interesting is the political shift happening behind the scenes. We are moving into a period where politicians are no longer just talking about crypto. They are starting to buy it. A notable example is Congressman Byron Donalds, who recently purchased $100,000 worth of Bitcoin. This was his first ever crypto purchase. He also sits on the Financial Services Subcommittee on Digital Assets. That is not a coincidence. When lawmakers who shape financial policy begin investing personally, it sends a powerful message. Cathie Wood summarized it perfectly when she said that once politics starts buying Bitcoin, the game changes. This is not just about speculation anymore. This is about positioning digital assets as part of national strategy. According to her, 2026 is not just another year, it is a midterm election year. President Trump does not want to become a lame duck. Crypto has proven that it can influence voter sentiment, especially among younger and tech-focused demographics. That makes it politically valuable. The original vision was not just to hold seized crypto, but to actively accumulate assets like Bitcoin as a strategic reserve. That shift from passive holder to active buyer could be one of the most important developments in crypto history. We already saw what happened when Trump won the election in 2024. Crypto markets surged on optimism, but 2025 was more mixed. The big question now is what happens in 2026. If the political environment remains pro-crypto, we could see renewed momentum. If power shifts in the opposite direction, the market could face resistance again. This is not about daily price movements. This is about the structural future of digital assets. At BullionIQ, we do not pretend to predict the market day by day. Anyone who tells you they know exactly what will happen tomorrow is not being honest. What we do is analyze the forces shaping the market so you can make informed decisions. This content is for education and discussion, not financial advice. You must always do your own research before investing. And remember, I will never contact you privately asking for money or offering guaranteed returns. If someone does, they are a scammer, because one of the biggest mistakes crypto investors make is assuming that adoption is moving in the same direction everywhere. It is not. While the U.S. is slowly becoming more open to digital assets through regulation, political interest, and institutional involvement, other parts of the world are moving much more cautiously. And this global split in policy is becoming one of the most important forces shaping where capital flows next. A clear example of this comes from Europe. The European Central Bank has made it very clear that Bitcoin and other cryptocurrencies will not be included in their central bank reserves. Christine Lagarde has stated that for something to be held as a reserve asset, it must be liquid, secure, and safe, and not tied to speculative risk. In her view, crypto does not meet those requirements. This signals that, at least for now, Europe is not interested in treating digital assets as strategic financial tools in the same way some voices in the United States are beginning to discuss. This difference in policy matters more than many people realize. When governments and central banks adopt or reject an asset class, it influences everything from institutional investment to innovation, startups, and even retail confidence. If the U.S. moves toward clearer regulation and a more pro-crypto stance while the European Union remains restrictive, capital, talent, and technology may increasingly flow toward the U.S. That creates a competitive advantage. Markets follow opportunity, and opportunity follows regulatory clarity. Many people living in Europe are already feeling economic pressure. Growth has been slow in several major countries, inflation has hurt purchasing power, and policy decisions often feel disconnected from everyday reality. In that environment, when people see the U.S. talking about tax relief, crypto-friendly leadership, and technological innovation, it naturally raises questions. Will Europe eventually change its position? Or will it double down on control through tools like central bank digital currencies? This is a critical point. While the EU appears hesitant to embrace decentralized crypto assets, it has shown strong interest in CBDCs, or central bank digital currencies. These are government-issued digital currencies that offer efficiency and traceability but lack the decentralization that makes crypto attractive to many users. If Europe pushes forward with CBDCs while rejecting assets like Bitcoin and XRP, it may create a system that is digital in form but centralized in control. For investors, that distinction is crucial. One model empowers individuals and markets, the other strengthens institutional oversight. Now let's bring this back to XRP, because while political narratives shape the long-term picture, market behavior often gives us early signals about what participants are actually doing. One of the most interesting data points right now is the decline in large XRP transfers to exchanges like Binance. Historically, when large amounts of crypto are moved onto exchanges, it often signals intent to sell. When that activity slows down, it suggests that selling pressure may be decreasing. Since mid-December, XRP flows to Binance have dropped sharply. In simple terms, fewer large holders appear to be sending XRP to exchanges for liquidation. This does not guarantee a price increase, but it does reduce one of the main sources of downward pressure. When supply coming to market decreases and demand remains stable or increases, the balance begins to shift. That said, we must be honest about recent price action. XRP experienced a strong multi-day rally, followed by a pullback of roughly 14% over the past several days. This is not unusual in crypto. Rapid moves to the upside are often followed by corrections as traders take profits and leverage gets flushed out. The key question is not whether pullbacks happen, but whether the underlying structure remains intact. From an analytical perspective, this type of correction can actually be healthy. It resets momentum, reduces excess speculation, and allows long-term participants to re-enter at more reasonable levels. What matters is whether the market forms higher lows over time and whether fundamental conditions continue to improve. Regulatory progress, political support, and decreasing exchange inflows all suggest that the long-term story remains intact, even if short-term volatility continues. It is also important to understand how broader risk appetite affects crypto. Recently, traditional markets such as the Russell 2000 have reached new highs. Historically, when smaller cap stocks perform well, it signals a willingness among investors to take on more risk. This environment usually benefits speculative and emerging asset classes, including crypto. However, that risk appetite is not fully translated into digital assets yet. This tells us that investors are still cautious, possibly due to regulatory uncertainty, geopolitical risk, and macroeconomic policy. Another factor that could influence retail participation is tax policy. The U.S. administration has been promoting tax relief measures, including no tax on tips, no tax on Social Security, and no tax on overtime. Whether or not these policies are fully implemented, the narrative is clear: more disposable income for everyday Americans. When people have more money left over, they are more likely to invest, speculate, and explore higher risk opportunities. Crypto has historically benefited during periods of excess liquidity and rising retail participation. However, we must avoid emotional thinking. More cash does not automatically mean higher crypto prices. It depends on confidence, narratives, and alternatives. If stocks, real estate, or other assets appear more attractive or safer, capital may flow there instead. This is why understanding the broader economic environment is just as important as following crypto-specific news. Right now, we are in a transitional phase. The market is caught between short-term uncertainty and long-term potential. Political decisions, court rulings, and economic data are creating noise in the system. At the same time, structural developments like regulatory frameworks, institutional interest, and declining selling pressure are quietly building a foundation. For XRP holders, this is not a time for panic or blind optimism. It is a time for strategic thinking. The market is telling us that volatility is still here, but it is also telling us that some of the strongest selling forces are weakening. When you combine that with growing political relevance and the possibility of regulatory clarity, you begin to see why this period may be far more important than the price action of any single day. It is important to understand something that many traders overlook. Crypto markets are no longer driven only by technology, hype, or retail emotion. They are now deeply connected to politics, regulation, and institutional strategy. This means that to understand where assets like XRP are going, we must look beyond charts and into incentives, power, and long-term planning. One of the biggest shifts happening right now is how governments are beginning to treat digital assets. For years, crypto existed outside the traditional financial system. Regulators were unsure how to define it, politicians were cautious about supporting it, and institutions stayed mostly on the sidelines. That era is ending. What we are seeing now is the early stage of crypto becoming part of national economic strategy. The comments from Cathie Wood highlight this perfectly. When she says that once politicians start buying Bitcoin, it is game over, she is not talking about price in the short term. She is talking about legitimacy. The moment policymakers become personal investors, crypto stops being a fringe experiment and starts becoming something that matters at the highest levels of decision-making. That changes how laws are written, how risks are assessed, and how future policy is shaped. This is especially important in an election cycle. In 2026, the United States will hold midterm elections. Historically, midterms are about control, momentum, and political survival. No sitting president wants to lose influence halfway through a term. Crypto has become a tool in that equation. It appeals to younger voters, technology communities, entrepreneurs, and even libertarian-leaning investors who care about financial independence. Supporting crypto is no longer just about economics. It is about building a coalition. For the market, this introduces a powerful dynamic. When an asset class becomes politically valuable, it tends to receive more protection, clearer rules, and more institutional acceptance. This does not mean prices go up in a straight line. It means the probability of long-term integration into the financial system increases. For XRP, which is designed to operate within banking, payments, and cross-border settlement, this environment is especially relevant. Let's talk about XRP's position in this changing system. Unlike many cryptocurrencies that focus on decentralization above all else, XRP was built to solve real-world financial problems, particularly in payments and liquidity. Its core use case is fast, low-cost cross-border transfers. This makes it attractive not just to retail investors, but to banks, financial institutions, and potentially even governments. In a world where regulation is becoming clearer and institutional adoption is increasing, assets that align with existing financial infrastructure may have a unique advantage. However, this also creates tension. Crypto was originally about removing intermediaries. XRP's model involves working with them. Some in the crypto community see this as a compromise, but from an analyst's perspective, this design could make XRP one of the first digital assets to achieve large-scale regulated adoption. In other words, while other projects fight the system, XRP is positioning itself to become part of it. That brings us back to regulation, particularly the Clarity Act. If passed, it would provide a framework that defines which assets are securities, which are commodities, and how they are regulated. This matters because uncertainty is one of the biggest barriers to institutional investment. Large financial players do not like legal risk. They do not want to invest in something that could be restricted or reclassified overnight. Clear rules reduce that risk. For XRP holders, this could be transformational. For years, XRP has operated under a cloud of legal questions. While parts of that battle have already been resolved, a comprehensive regulatory framework would remove lingering doubts. That does not guarantee immediate price appreciation, but it opens the door for broader adoption, partnerships, and infrastructure integration. Another factor we must consider is timing. Markets often move in anticipation, not in reaction. By the time a law is officially passed or a policy is fully implemented, much of the positioning may already be done. This is why exchange data, on-chain metrics, and institutional behavior are so important. They offer clues about what informed participants are doing before headlines confirm the narrative. We already discussed how large XRP transfers to exchanges have declined, suggesting reduced selling pressure. This aligns with a broader pattern seen in maturing markets. Early speculative holders exit, while long-term participants accumulate quietly. This does not eliminate volatility, but it gradually shifts the market from emotional trading to strategic allocation. Now let's address the emotional side of the market because psychology plays a massive role in crypto. Many investors get caught in cycles of fear and excitement. When prices surge, they feel confident and chase the market. When prices pull back, they panic and sell. Professional investors, by contrast, focus on structure, incentives, and probabilities. They ask, what is changing in the system? What forces are becoming stronger? What risks are being reduced? Right now, several forces are clearly shifting in crypto's favor. Political interest is increasing. Regulation is moving toward clarity rather than prohibition. Institutional participation is no longer hypothetical. At the same time, global uncertainty, inflation, and geopolitical tension are reminding people that traditional systems are not risk-free either. Crypto is no longer just an experiment. It is becoming an alternative framework. That said, we must remain realistic. This transition will not be smooth. There will be setbacks, policy debates, market crashes, and periods of disappointment. The crypto market is still young compared to traditional finance. It is sensitive to headlines and vulnerable to speculation. Anyone expecting a straight line upward is setting themselves up for frustration. For XRP specifically, the next phase is likely to be defined by integration rather than speculation. That means progress may appear slow on the surface. Partnerships, regulatory approvals, and institutional pilots do not always create immediate price spikes, but they build the foundation for long-term value. The real question is not whether XRP will experience volatility. It will. The question is whether its role in the financial system will expand over time. If governments move toward digital asset frameworks, if banks continue exploring blockchain-based settlement, and if cross-border payments demand faster, cheaper solutions, then XRP's design places it in a strong strategic position. At BullionIQ, our goal is not to tell you what will happen tomorrow. Our goal is to help you understand the forces shaping the market so you can make better decisions. Right now, those forces point to a market in transition, not collapsing, not exploding, but evolving. Now that we have explored politics, regulation, and institutional behavior, it is time to look at the market structure itself. Understanding market dynamics is just as important as understanding laws and policies because ultimately price moves are determined by supply, demand, and liquidity. And in crypto, those dynamics can change very quickly, sometimes in ways that traditional investors do not expect. Let's start with liquidity. Liquidity is simply how easily an asset can be bought or sold without affecting its price too much. For XRP, liquidity comes from exchanges, OTC desks, and institutional participants. We saw earlier that large XRP transfers to exchanges like Binance have decreased. That is significant because fewer tokens hitting the market can reduce selling pressure. In a simple way, when supply slows and demand remains constant, prices are more likely to stabilize or even rise. But this doesn't mean there won't be swings. Crypto is inherently volatile, and smaller markets can react sharply to large trades or news events. At the same time, investor behavior is shifting. In the past, a large portion of the XRP supply was held by speculative traders looking for quick gains. These traders often react emotionally, buying during rallies and selling during dips. Today, we are beginning to see a subtle but important change. Long-term holders and strategic participants are increasing their share of supply. This kind of smart money accumulation usually signals that those with experience and resources believe in the long-term story, not just the short-term price movements. Another important factor is market sentiment. Sentiment can be influenced by news, politics, and even social media. For example, when Cathie Wood and other respected investors talk about crypto being a strategic asset for politicians and institutions, it creates a narrative that shapes investor confidence. People start asking, if professionals and lawmakers are buying, maybe this is more than just hype. This psychological factor can drive capital flows independently of fundamentals. We also need to consider macroeconomic conditions. The United States is releasing unemployment data, and tax relief measures are being implemented, meaning Americans may have more disposable income. Historically, periods of extra liquidity can lead to higher risk appetite. People tend to explore new investment opportunities, including crypto. Similarly, risk on environments in traditional markets, like the recent highs in the Russell 2000, can signal that investors are willing to allocate capital to emerging assets. Crypto doesn't operate in a vacuum. It is influenced by broader economic confidence. Volatility is another key component. While the decrease in selling pressure and accumulation by long-term holders is positive, crypto remains extremely sensitive to news. Supreme Court rulings, Fed policy, and geopolitical developments can all trigger sudden price moves. This is why corrections, like the 14% pullback we recently saw in XRP after a multi-day rally, are normal. Instead of being a sign of weakness, these pullbacks often reset momentum, flush out short-term traders, and create opportunities for strategic accumulation. From an analytical perspective, the combination of reduced selling pressure, long-term accumulation, and improved sentiment creates a scenario where the market could move higher in the medium term. However, timing remains uncertain. Markets often move in anticipation of events, meaning that prices may react before headlines confirm them. Traders who understand this can position themselves strategically rather than reacting emotionally to daily fluctuations. Another structural factor is adoption. XRP is built to solve real-world problems, especially in cross-border payments. Unlike other cryptocurrencies that rely solely on speculation or decentralized narratives, XRP's design aligns with existing financial infrastructure. Banks and financial institutions are already exploring blockchain solutions for efficiency and cost reduction. If regulatory clarity comes through and institutions are able to legally hold and use XRP, this could provide a significant catalyst for long-term growth. It's also worth noting that regulatory clarity doesn't just remove risk, it changes behavior. When institutions know that rules are clear, they are more likely to move from passive observation to active participation. This could include partnerships, pilot programs, or strategic reserves of XRP. These moves do not always create immediate price spikes, but they build the foundation for sustainable, long-term growth. Of course, we cannot ignore global differences. While the US may be moving toward a pro-crypto framework, other regions like the European Union remain cautious. They are focused on CBDCs and regulatory oversight rather than embracing decentralized assets. This creates a divergence where US-friendly policies may attract capital, talent, and adoption that Europe is currently missing. For global investors, this is an important strategic consideration. Finally, we must understand the balance between opportunity and risk. Crypto, by nature, is volatile and unpredictable in the short term. Regulatory delays, political developments, or unexpected economic shifts can trigger rapid moves. But the combination of structural improvements, political interest, decreasing selling pressure, and long-term accumulation suggests that the underlying story for XRP remains intact. The market may fluctuate daily, but the broader trend is increasingly constructive. In summary, Part 4 shows that market structure, liquidity, investor behavior, and macroeconomic conditions all matter as much as politics and regulation. XRP is in a unique position. Reduced selling pressure, growing long-term holders, and strategic use cases create a favorable environment. However, volatility and uncertainty remain, meaning that strategic positioning, patience, and understanding of the forces at play are essential. Institutional behavior, market structure, and investor psychology, it's time to put everything together and look at what could realistically happen next for XRP. This is where all the pieces, news, data, and trends come together to form potential scenarios, so holders can make informed decisions instead of reacting emotionally to every price swing. The first scenario to consider is a regulatory clarity-driven rally. If the Clarity Act passes, or if other crypto-friendly legislation is implemented in the United States, it would remove much of the uncertainty that has clouded XRP for years. Institutional investors, banks, and high-net-worth individuals would be more confident to hold and use XRP, not just trade it. The reduced legal risk could trigger partnerships and pilot programs for cross-border payments, increasing real-world demand. This scenario would likely lead to gradual upward price pressure, with corrections along the way as short-term traders take profits. It's important to remember that these moves are usually not explosive overnight. They are structural, slow, and sustainable. The second scenario is political volatility affecting price. We know that XRP, like all crypto, does not exist in isolation. Supreme Court rulings, tariffs, Fed policy, or midterm election results could create sudden swings. If the political environment is pro-crypto, markets could react positively. Conversely, unexpected regulatory delays or opposition could trigger temporary pullbacks. XRP holders should expect these fluctuations and avoid panic selling during short-term drops. Instead, view them as opportunities to accumulate if the long-term fundamentals remain strong. Another key factor is market liquidity and exchange flows. As we've discussed, XRP transfers to exchanges like Binance have decreased, suggesting reduced selling pressure. When supply coming to market slows while demand remains steady or increases, it creates a more favorable balance. This does not eliminate volatility, but it increases the probability that any upward trend will be supported by strong technical and fundamental forces. Smart money accumulation combined with fewer tokens on exchanges is a classic signal that longer-term holders are positioning for the next phase. Next, we have institutional and strategic adoption. XRP's core use case, fast and low-cost cross-border payments, is attractive to banks and payment providers. If regulatory clarity allows institutions to hold XRP without legal risk, we could see a shift from experimental pilots to real integration. This would create demand beyond retail speculation. Unlike most crypto projects, XRP is uniquely positioned to benefit from real-world utility, which can sustain value even if broader market sentiment turns temporarily negative. Global divergence also plays a role. While the US appears increasingly supportive of crypto, Europe remains cautious, favoring CBDCs over decentralized assets. This means that capital and innovation could increasingly gravitate toward US-friendly environments. For XRP, this could translate into adoption, partnerships, and attention from global investors who see regulatory clarity as a competitive advantage. Those who recognize this trend early could benefit strategically. Volatility, however, is still a reality. Pullbacks, corrections, and swings will continue to happen. XRP recently experienced about a 14% correction after a strong multi-day rally, which is normal in crypto markets. Professional investors view this as healthy, a way to reset momentum, and an opportunity to enter at better prices. For holders, understanding this dynamic is key. Short-term drops do not necessarily indicate a failing market. They are often part of the natural rhythm of growth. Looking ahead, timing will be crucial. Markets move in anticipation of events, not just in reaction. Regulatory announcements, Supreme Court rulings, midterm election outcomes, or significant institutional buys could all create preemptive movements. XRP holders who track these developments closely will be better positioned to act strategically rather than emotionally. In other words, the edge comes from preparation, not speculation. Another scenario to consider is global macroeconomic influence. U.S. tax relief measures, increasing disposable income, and risk-on behavior in traditional markets may drive more retail participation in crypto. However, this is balanced against global uncertainty, inflation concerns, and geopolitical tension. Crypto does not exist in a vacuum. It reacts to the same forces affecting traditional markets, but often more dramatically because of its smaller size and higher leverage. So, what should XRP holders do? First, remain informed. Subscribe to channels like BullionIQ, follow reliable news sources, and track regulatory and political developments. Second, avoid emotional decisions based solely on short-term price swings. Use pullbacks to evaluate accumulation opportunities if you believe in the long-term fundamentals. Third, understand your own risk tolerance. Even if all fundamentals are positive, crypto is inherently volatile. Allocating responsibly is essential. Finally, think long-term. XRP's future is not just about daily trading, it's about positioning in a market that is evolving from speculation to strategic adoption. Regulatory clarity, institutional involvement, declining selling pressure, and global demand dynamics all suggest that the long-term trend is constructive. Short-term fluctuations will occur, but holders who focus on these structural developments may find themselves better positioned for significant opportunities. In conclusion, XRP is at a crossroads. Reduced selling pressure, strategic accumulation, political relevance, and potential regulatory clarity create a strong foundation. Volatility remains, but the market structure is improving. The next weeks and months will be critical in determining how these forces play out. By staying informed, disciplined, and focused on fundamentals, holders can navigate uncertainty while positioning for potential long-term growth.